Hi, this is Rowland from Money and Markets TV. I wasn't surprised by Standard & Poor's downgrade of 9 European nations last week, but the bigger news came on Monday when S&P also downgraded the European Financial Stability Facility. The EFSF is the bailout fund that was supposed to save the Eurozone's more unstable members. So the question now is, will the rescuer itself need a rescue? Either way, if you still have any ETF exposure, now might be a good time to get out because the next phase of the sovereign debt crisis is about to begin. Remember that big agreement in November to save Greece from default? Well, it's not working out so well. Greek one-year government bonds now have an annualized yield north of 400%. That's a clear indication that bond traders believe default is imminent. And I think they're right. Greece will probably be ejected from the Euro currency union. But I'm more interested in the impact on the rest of Europe, especially Germany. A couple months ago, I told you about an instrument that acts as a canary in a coal mine for the sovereign debt crisis. The PowerShares DB3X German Bond Futures ETN has held up fairly well, meaning that traders still think Germany is creditworthy. But I'm seeing an ominous triple top on the Bund chart at around $30 per share. Technically, that's a bearish sign. It means a breakdown is probably coming, and the decline could happen quickly. Beyond Germany, the S&P downgrades could have an impact on the 9 nations affected: France, Italy, Spain, Portugal, Austria, Cyprus, Malta, Slovakia, and Slovenia. The big name on this list, of course, is France, the second largest economy in the Eurozone. Initially, the French bond market actually rose after the downgrade, much as our Treasury market did when the U.S. lost its AAA credit rating in August. But unlike the U.S., France does not control its own currency. Its fate is tied to the euro. And the euro is hostage to the whole continent's political paralysis. For ETF investors, I'd recommend being very careful about holding anything that has exposure to European stocks. For now, it might be a good idea to avoid the countries that were just downgraded, including funds sponsored by iShares focusing on France, Italy, Spain, and Austria. But there are also several broader European funds that are likely to be affected by the S&P downgrades. We could see some short-term rallies in some of these ETFs as analysts digest the latest news, but I wouldn't try to trade those rallies unless you're very nimble and prepared to get out quickly. I should mention that there's now also an ETF covering Greece, the Global X FTSE Greece 20, but it should go without saying that I don't recommend it. Overall, I think you can find better opportunities in other parts of the world, such as Asia. In fact, I recently recommended funds focusing on 2 Asian countries with very strong growth prospects to my international ETF trader members. I'm Ron Rowland for Money and Markets TV. Thank you for watching.